welcome to BQ Prime. I'm Hirodadia. Joining us on the show is Anmol Jain, Joint Managing Director at Lumax Industries, joining in. Welcome to the show, Anmol. And firstly, congratulations on the announcement of the Greenfield project. Firstly, if you could help us understand modalities in terms of the Greenfield expansion that we're talking about.
Thank you, Ariel, for having me on the show. Well, we've always maintained that if you see our performance, it has been a very robust performance for Q2 and H1. I also mentioned in the past that we have a very healthy order book of almost close to 1,000 crores of revenues. So, of course, we could not meet that revenue from the current capacities. And we've shortlisted the West region in Chakan in Pune for a Greenfield facility. So it would be largely catering to the Western customers, Tata, Mahindra, at some point of time also Skoda. And again, these are confirmed orders. So we are going ahead and building this plant to service our clients in the forthcoming future.
Right. One interesting aspect that we notice over here is that in terms of where the capital outlay goes, that stands at around 175 crores, whereas we're looking at a revenue visibility of almost 600 crores, which is almost 3.5 times the revenue potential versus the capex. So is this going to be the only investment for the 600 crore revenue visibility, or this is just phase one and there will be an additional capex to get to that 600 crore revenue from this plant?
So the plant is obviously built for a much larger capacity. The phase one investment outlay would be up to about 175, which would fetch about 600 crores. And the reason for this improved investment to sales ratio is purely because these are all advanced lighting with higher technology. So the value per lamp is per se more than what the conventional lamps are. These are all with LED technologies. But this is phase one. At some point of time, in maybe about 3 years, if all goes well, we will kickstart phase two. And I think the total projected revenue from this plant at the end of phase two might be even up to about 1,000 crores.
Right. And even in terms of phase two, will the capital outlay be at 175 crores or will it be slightly more or less?
Too soon to give you a number for the phase two. It really depends on the kind of programs and the kind of volumes which are indicated at that point of time. But I would say it would be definitely lesser than this phase one outlay.
Okay. And overall, for this phase one, as we know that, clearly in terms of where timelines are concerned, I think the second quarter is what we are looking at, right? So are we actually, have we already assigned the orders to achieve this peak revenue potential, or orders are still awaited?
No, so it's definitely, we have confirmed orders from our customers, and that is the reason we have given a clear timeline of Q2 of FY24 for us to commission this plant and start mass production. Of course, the construction is in full swing. This is a build-to-suit lease model. So, it is in an industrial park where it is pretty much plug and play. So we are short on time, and that's why we thought this is the best model to adopt to accelerate the development and service our clients. So Q2 FY24 is when this plant will go on stream.
Right. And are we seeing this entire 600 crores revenue recognition in FY24 as a whole?
I would say for the most part, not all of it will come in FY24, but probably almost 50% to 60% should come in FY24 itself. And then subsequently, the peak revenues would be in about FY25.
Right. So overall, if you see in terms of the order book as well, the 1,000 crores, as you just mentioned, which is spread over 1 to 2 years, out of which around 30% is going to come from EVs. So with regards to this plant as well, how are you seeing that bifurcation between EV and non-EV, number one? And will we see a further addition to this order book, or will it be at 1,000 crores for the next 2 years?
No, so this plant, for the confirmed orders, which will fetch us about 600 crores, right now there is no EV platform on it. We have got certain EV platform orders, which is a part of the 1,000 crores, but those will be commissioned in certain other facilities in the years to come. And again, out of the 600 crores, which is confirmed orders, we are looking at few more programs which should get confirmed in later part of this year, which will eventually get commissioned in this plant. So 600 to 1,000 crore journey will not be on the same programs. It will
Right.
be on new programs, which some of them will be awarded in probably the next 12 months.
Right. Apart from that, in the second quarter earnings itself, we had seen that the capacity utilization was around 80 to 85%. And that time we clearly mentioned that going ahead, the company may have to increase capacity, especially near the M&M plant. So is this going to be the same plant that will cater to M&M? I know you mentioned about M&M and Tata Motors, but will this be enough, or will there be any further capacity addition coming in to meet, the requirement for M&M?
So we've seen a very strong growth from both Tata as well as M&M for our first half. And clearly, they also have grown significantly in numbers. So for the large part, this capacity is for M&M and Tata Motors. And in terms of capacity utilization, correct, largely this would be for the region. Our regional capacities are different, 80-85% at a company level. But since we were short on capacities in the West, this will help us in deliver the models and the programs for Mahindra, Tata, as well as Volkswagen in probably phase 2.
Right. And overall, from a funding perspective, I know it's a combination of debt equity. So how much of it is going to be debt and how much of it is going to be equity?
Well, it wouldn't be equity. It would be largely debt, and certain part would be from internal accruals. But I would say largely it would be from a long-term debt.
Okay. So currently, at the end of the first half of FY23, our debt to equity was at around 0.15 times. By how much will that go up?
I'm not sure on the financial numbers in terms of what exact long-term debt would there be, but we would be very comfortable in servicing this debt.
All right. And clearly, if you see in terms of growth prospects from here on as well, in terms of customers, as you mentioned, Tata Motors, M&M is already giving you good traction. But clearly, I think MSIL, 31% of your revenues come in from there. M&M and Tata Motors in totality is still around at 20-22%. So are we seeing that customer-wise sales mix change from here on?
No, I think we're very bullish on MSIL and SMG, and I think they would continue to be the number one customer for us. There is a big gap between number one and number two, number three, but I think on customers, we do see a strong growth, both in terms of the volume as the overall industry is getting back to the peak levels. This year we are expecting as an industry to cross the FY18, FY19 volume levels of 4 million plus. So I think the volume growth is coming from almost all the OEMs. But of course, with the new programs and the technological changes, there is also a value addition, a value growth which is coming with the new cutting technology. And that's exactly why you see a higher capital ratio in this facility vis-a-vis the current capital ratio which the company is operating at.
Right. And overall, from a segment perspective, are we seeing a mix on that, mix change on that front as well?
So yes, I think, we are largely always been more on the passenger vehicle side. I think almost 65% of the revenue for the lighting comes from the passenger vehicle, and the rest is in two-wheeler and then commercial vehicles. I think I do see a shift of technology even in two-wheelers, but since the value per vehicle is much, much higher, I would say that the passenger vehicle will continue to be the main driver for the growth. But again, I would say that the 65 may come down by a few percentages, but in absolute amount, all the three segments will continue to grow: the commercial, two-wheeler, as well as passenger cars.
Right. And overall, from a strategy perspective, backward integration, localization is something which Lumax Industries is adhering to, which is helping the company overall from a margin improvement perspective. So going ahead, what are the plans on that end? And, if you have to talk about coming quarters, what's the kind of optic that we could expect on a margin perspective?
So clearly, localization and let's say backward integration are two pillars. We've been focusing on. We did insource the electronics, which is critical to all these new technologies, and we also did see a margin expansion because of that insourcing. I think going forward, I would not say that we will be localizing a lot in-house, but definitely we will be getting the optimum supply chain to change from a import content to a deep localization within the country. And I would say that in terms of margin, I've always said our endeavor is to try and come closer to a teen margin EBITDA. So, we are at about 10 double digits for the quarter two. And I would say that, the first milestone would be getting across the 11.5%, and subsequently getting to 12% to 13% EBITDA levels.
Right. And if you could just throw some light with regards to the HVAC commissioning as well. We're anticipating that in the fourth quarter of FY23. So overall, what's the kind of revenue potential are we seeing in terms of FY24?
So right now it would be small because we've just got one program, but I think the peak volumes would really kick in by FY25. And I think the teams are already engaged with multiple other OEMs. So it's a step into a new product line, which was an expansion with our partner Stanley Electric. But I think I would say that it would be still 2 years before we can make a sizable revenue and margin expansion because of the HVAC.
Right. And then more overall with regards to the 100% ownership of Lumax Industries, which is the Czech Republic subsidiary, how is that going to help the business from here on from a technology and innovation capability perspective?
So very clearly, I think Czech was a step forward because a lot of our OEMs have the technical centers in Europe. We also see a lot of the design language on lamps and lighting specifically in India flowing in from the European styling, both in terms of architecture as well as lighting. So Czech has great talent, and we found it to be the right ecosystem to be there close to our OEMs so that we can get the right talent, the right skills, and also have a very close tie-up with our OEM technical centers. So it will not just help us in developing, in-sourcing the new cutting-edge technologies, but also help leverage those skill sets to upgrade our engineering capability here in India, so that we can have a better solution to be provided to our OEMs here itself.
Right. And very lastly, in terms of the key milestone that the company is looking to cross in terms of top line and bottom line in the next 2 to 3 years, and number two, do you think around 2,200 to 2,300 odd crores is the number that we will be able to achieve in terms of FY23?
Well, surely, I think if the market continues to look robust and, with the kind of positive sentiments, I would say that surely that number is something which surely should not be a problem to achieve. We've already done some 1,120 odd crores first half. So, arithmetically, that number should happen. Usually H2 is better than H1 traditionally. So I don't anticipate any issues there. And with a strong order book, I think the company is poised to grow at a much faster and a much higher rate than the industry as a whole is projected to grow over the next few years.
Absolutely. All right, Anmol, thank you so much for speaking to us at BQ Prime. Congratulations once again, and good luck for the coming quarters as well. Speak to you soon again.
Thank you very much. Thank you for having me.